Good evening, dear students. Good evening. Very good evening, everyone. Uh, so I welcome you back again to one more exciting session of revision. And today we are going to revise the topic of capital structure. Today we are going to revise the topic of capital structure, which is financing decision, capital structure. Uh, as we all are aware, this topic can be broadly divided into two parts, one of which is about the capital structure problems, in which we try to obtain what is the best capital structure for a company based on the EPS or NPS. And then second part is about the capital structure theory. Okay. So let's try to quickly, run through the concept of capital structure problems. We'll do few questions on that, and then we will go back to capital structure theory revision, and then we'll do certain problems. Okay. So in a typical capital structure pattern, if you want to know which particular, which particular uh, plan should be chosen, we are, normally going to be selecting a plan which is offering us a highest EPS. Based on the plan, you calculate your EBIT, PBT, PAT, net profit, and then the EPS. So generally, we choose the plan which is providing us with a higher EPS. And if the P ratio is also given to us, then we go down to another level where we choose the plan which is having the highest MPS. We'll definitely doing a couple of questions on that. Then conceptually, what we have is uh, the financial break-even point. So financial break-even point is essentially the one where, it's the level of EBIT at which your EPS works out to be zero. So financial break-even point is the level of EBIT at which our EPS is zero. Okay. So for that, we simply have a formula, and financial break-even point formula is what? Interest plus preference dividend divided by 1 minus T. Then we have an indifference point also, point of indifference. So the point of indifference is that level of EBIT at which EPS of two plans are same. So which means EPS of plan 1 is same as EPS of plan 2, and difference between plan uh, 2 and 3 can be also computed in the similar way. Now the important part over here is when we have indifference point, the important part about is that if your expected EBIT is less than the level of indifference, your expected EBIT is less than indifference point, then you say that less risky plan is preferred. And if your EBIT is greater than indifference point, riskier plan is going to be preferred. Okay. So if EBIT is less than indifference point, less risky plan is going to be preferred. And if EBIT is greater than indifference point, a riskier plan is going to be preferred. Okay. Now, let us do certain questions based on that, based on these concepts, and then we'll take up the next capital structure theory part. Okay. Open it in my app. Or Astha, why? Which part are you asking for as why? I didn't get it. For which part are you asking why? Hmm? Astha, for which part are you asking why? EBIT less than indifference point, why less risky plan is preferred? Because when the EBIT is less than indifference point, it means uh, your EBIT is lower, means you are in a situation where you're not generating sufficient profit. If you're not generating sufficient profit, obviously it's a part where you say that let me go for a lesser risky plan rather than going for a risky plan, because risk is acceptable only if you are likely to generate more profits. Because to support that risk, you should have a higher amount of profits. Okay, fine. Now this question number one, the question that we are looking at. Uh, so a company requires 50 lakh for expansion. It is considering three alternative financial plans. Plan A is 100% equity, where you're going to raise fully equity at a face value of 10. Plan B is 50% equity. Okay, Plan B is 50% equity and 50% debt. And Plan C is 30% equity, 70% debt. Now, current EBIT level is 12 lakh and it is expected to increase by 25% after this expansion. Corporate tax rate is 30%. Cost of equity is going to increase with leverage. So plan A is having equity of 14%, 18%, and 24%. We have to compute the EPS under each of the plan at expected EBIT, degree of financial leverage under each plan, and then we'll evaluate the risk return trade-off and EBIT EPS analysis. That's the second part. But I think first two parts, can we do it? Can I solve these first two parts, guys? Can we do the first two parts? Yep. Can you solve the first two parts, guys? Yes or no? Can we solve it? The first two parts, you have to compute the EPS under each of the plan, right? Okay, wait. Good enough. So we can start, guys. Try to solve it. Get the first two answers. Then we'll go with the next part. Assume that new EBIT apply to all plans. Yes, of course, the EBIT is going to be same for all the plans. That's true. Okay, let me just try to solve it. We have plan 1, plan 2, and plan 3. So for all the three plans, um, we have like plan A is keeping 100% equity, 100% equity, so requires 50 lakh for expansion. If it's 50 lakh for expansion, plan 1 is to raise fully by way of equity. This is equity and debt. Now, debt is, of course, another two different level, debt at 12% and also at 14%. So, in plan 1, which is fully equity, 100% equity, so it's 50 lakh fully. Total 50 lakhs. Plan 2, 50% equity, 50% debt at 12%. So it is 25 lakhs and another 25 lakhs. Total 50 lakh. Plan 3 is 30 and 70. 30 is essentially 15 lakh of equity and 35 lakhs of debt. We start with EBIT, right? So remember EBIT is 12 lakh, but is expected to increase by 25%. So for our given level of the capital expansion for 50 lakh, you're going to get an EBIT of 12 lakh into 25%. 12 lakh into 25%. Okay. So it's going to be 4 lakhs. EBIT is going to be 4 lakhs. No, my bad. It's got 12 lakh into 25%. Okay. So it's going to be 3 lakh. My bad.
Hey, just quick question. Wouldn't the EPIT increase from to 15 lakhs? Because it's an increase of 25 percentage.
Yes, there's an increase of 25%. But are we taking the entire capital or only the additional capital?
I was assuming the entire capital.
Only the additional
Like,
capital, right?
oh, okay, okay,
Right. So we should take the additional EBIT only,
okay. Then all my calculation is wrong. I'll
right?
try again.
So since it is 50 lakh for expansion, that 50 lakh can be raised by either plan A, B, or C. right? So
Okay,
it's the
thank you.
additional thing. So it's going to be only 3 lakh. From this, we are going to subtract the interest, which is 0, and then 25 lakh into 12%. Is over here 3 lakh, and then on the other side, it is 35 lakh into 14%. It's 4 lakh 90,000. So we have the PBT as 3 lakh 0 and negative 1 lakh 90,000. From that, you're going to pay tax. What's the tax rate? 30%. Tax rate is 90,000. Here it is going to be 0. Here it will be 1 lakh 90,000 to 30%.
Okay, sorry, it's negative amount, right? So why do you want to calculate 30%? Shouldn't it be
You'll
zero?
save tax on that, right?
Okay, okay.
Get a PAT of 2 lakh 10,000 0 and says what? 1 lakh 90,000 minus 57. 1 lakh 33,000. Now divided by number of equity shares. Here it is 5 lakh, 2 lakh 50,000. And here it is what? 1 lakh 50,000. We get the EPS. 2 lakh 10,000 divided by 5 lakh. 0.42 0, and this is what? Negative 1 lakh 33,000 divided by 1 lakh 50,000. That's negative 0.89. Okay, so we got the EPS numbers. Of course, looking at EPS, we got the computed EPS number. Calculate the degree of financial leverage. Now, degree of financial leverage. What's the formula for degree of financial leverage? That's EBIT upon PBT. Here it is 1. Now, this is something, you say it as not defined financial leverage. And then on the other side, 3 lakh divided by 1 lakh 90,000. So it is going to be minus 1.57. So it's basically negative means when the EBIT is, if you increase your EBIT, your PBT is going to be getting impacted by negative 1 point or 1.57. 3 lakh divided by 1 lakh 90,000. EBIT upon PBT. Then evaluate the risk return trade-off and recommend the optimal plan. Now, risk return trade-off, one important part over here is, if you're going for, plan 2 or 3, where you're taking debt, where you're borrowing money and trying to run the business, you're actually entering into either no profit or into negative profit. Rather, you should go for only first plan. But most important part is cost of equity is going to increase with leverage. Of course, plan B and C is out of any question. And since over here, plan A, the cost of equity is 14%. So let us first talk of what is the return on equity that we are getting. Return on equity is 2 lakh 10,000 upon 50 lakh. 2 lakh 10,000 upon 50 lakh, which is just 4.2%. So as an equity investor, we want 14%, but whereas the projects are likely to give you 4.2%. So should we make an investment into this project or no? Should we be making an investment into this project or no? Hmm? Should we make an investment into this project or no? We should not, right? Because the returns are not sufficient to be matching our cost, right? And obviously, EBIT is EPS analysis is not sufficient. Predicting whether just EBIT EPS is sufficient for decision making, no, because we need to also look at what is the risk involved in the particular project. Now, look at the question number 2. Try out this question, guys. Try out this question now. Question number in that also do just 1, 2, and 3. Just do 1, 2, and 3. Is as the negative DFL means for every 1 rupee increase in EBIT, there will be 1.57 lower of EBT. No, but EBT will increase, but then the answer is negative right now. I mean, the number is negative. But obviously, if the EBIT increases, your EBT is also going to increase. But since we are in the negative territory, in the profit, negative profit or loss, therefore we are getting that as a negative. What is the future face value share in the second question? Assuming 10. Yeah, you can assume 10. You can assume 10 as the face value. And okay, firm is considering two financing alternatives. Plan X is 40 lakh equity, no debt. Plan Y is 20 lakh equity and 20 lakh debt at 10%. Tax rate is 35%. Compute the EBIT indifference point. Determine the EPS under both plans at EBIT levels. So, to compute the EPS at each of these levels, and then EBIT range where which the each plan is preferable. So first we need to get the indifference point. Now for indifference point, I need to plan what's going to be the EPS of plan X, or rather I can say indifference point, we can get it easily. Indifference point of X is what? Interest plus preference dividend upon 1 minus T. And since there is no interest, so indifference point of X is 0, right? And sorry, that's a break-even point. My bad, my bad. So we'll say EPS of plan X. EPS of plan X is going to be EBIT minus, there's no interest, this PBT into 1 minus tax rate is 35%, which is 1 minus 0.35. EBIT minus 0 into 1 minus T upon number of equity shares. Let's take it as 4 lakh. This should be equal to EPS of plan Y, which is EBIT minus interest of 2 lakh, because 20 lakh is the amount of debt. So of course on that 10%, you can say this into 1 minus 0.35 upon number of equity shares is 2 lakh. We have to just equate both of them. So this is 0.65 EBIT upon 4 lakh is equal to 0.65 EBIT minus 2 lakh into 0.65. So that's 1 lakh 30,000 upon 2 lakh. And then we cancel out both and we just say it is 2 over here. So that's 0.65 EBIT is equal to 1.3 EBIT minus 2 lakh 60,000. Right? So we place all EBIT on one side. So we have 2,60,000 is equal to 0.65 EBIT. So EBIT is 2,60,000 by 0.65. What is this EBIT, guys? 2,60,000 divided by 0.65, which is 4 lakh. EBIT is 4 lakh. So our indifference point is 4 lakh. Indifference point is 4 lakh. And then we compute EPS under both plans at EBIT levels. So for X and for Y at an EBIT level of, let me quickly do it in Excel that we can obtain the answer quickly. X and for Y, we have the EBIT levels. EBIT levels are 6 lakh, 10 lakh, and 16 lakhs. 6 lakh, 10 lakh, and 16 lakhs. So we have for plan X, there's no interest, right? So for plan X, there's no interest. I can simply use the 0.65 into EBIT, 0.65 into EBIT divided by number of shares, which is 4 lakh. These are your EPS. And for this is going to be EBIT minus interest, sorry, is 0.65. 0.65 into EBIT minus 1,30,000 divided by number of shares is 2 lakh. We can see these are the values of EPS that we are getting. Just verify, guys, are we getting these values as EPS? Hmm. Yes, perfect. So we got the EPS level. Determine the EBIT range where each plan is preferable. Now, that's quite easy. Now, EBIT is 4 lakh. EBIT is 4 lakh. Uh, Not for plan Y. We're getting something else for plan Y. Asta, something else for plan Y, or you're not done yet with plan Y? Point 0.65, 0.65, 1.3, 2.275. How come? EBIT is 6 lakh multiplied by 0.65 minus the post-tax interest, 1,30,000. What is the mistake that you did? Just check. Otherwise, Balmurugan, you got it, right? Okay. Now, identify the EBIT range where each plan is preferable. Now, since our EBIT level is 4 lakh, we can simply come up with EBIT less than 4 lakh. Which plan is going to be preferred, guys? Less than this. So a less risky plan is plan X because it doesn't have any interest component. And if it is greater than 4 lakh, then a more risky plan Y is going to be preferred. Got it, guys? Conduct the sensitivity analysis assuming interest rate to increase by 14%. Interest rate increases to 14%. Now, what will happen to the indifference point? What will happen to the indifference point if, let's say, rate of interest is 14%? You're going to create this equation in the similar way, but the change is now interest is not going to be 2 lakh, but rather the new interest value, instead of 2 lakh, it will be 2 lakh 80,000. It's going to be 2 lakh 80,000. You do EBIT minus 2 lakh 80,000, and then you do the recalculation thing and you get the new EBIT. So can you give me the new EBIT, guys? I mean, new indifference point at rate of interest of 10%. New indifference point at rate of interest of 10%. Calculate it, guys. Get the new indifference point. How much is it? 5 lakh 60? 5 lakh 60 for the 14% interest rate.
Yeah.
Okay, so you can see as the rate of interest just increases by 4%, your EBIT is increasing from 4 lakh to 5 lakh 60, right? So 4% increase in rate of interest leads to, can I say 40% increase in indifference point level. Rather, you can say there's a simultaneous, like 10% becomes 14%. So it's actually a 40% increase in the rate of interest. So rate of interest and increase in rate of interest, increase in indifference point are on a similar percentage, right? 40% is the answer that we are getting, right? Got it? Interpret the managerial implication of indifference point instability. Indifference point actually is dependent on the rate of interest. So as the rate of interest changes, the indifference point is also going to change, right? And therefore, we see that this is going to be definitely a changing thing. So, implication that you need to recompute the indifference point again and again. Okay, fine. Then, yeah, try out this third question now. Yeah, you can assume question 3 face value as 10. Okay. Hmm. A company has a debt of 30 lakh, preference share of 10 lakh, tax rate is 25%. You have to compute the financial break-even point. That is where EPS is zero. So financial break-even point, we know it is interest plus preference dividend upon 1 minus T. So interest is 3,30,000 plus preference dividend is 10 lakh at the rate of 12%. It's 1,20,000 divided by 0.75. So what's the financial break-even point? 4,90,000. Is it 4,90,000? Yep. Okay. Then compute the EPS at EBIT levels of 5 lakh, 10 lakh, and 15 lakh. So what are these numbers? For that, we need to first decide the EPS value. EPS value is EBIT minus interest of 3,30,000 into 1 minus 0.25 minus preference dividend of 1,20,000 divided by number of equity shares. Number of equity shares. Uh, for EPS, we don't have. Company has preference shares. Debt is given. Okay. So we don't have. Uh, what is it? The number of equity shares, right? So number of equity shares is. Let's just assume it to be maybe 1 lakh. Just a random assumption. 1 lakh. Right. So if you assume the EPS as, I mean, number of shares is 1 lakh, then what's the EPS level? Just assume this as 1 lakh and try to get it. Yep. So I think I should be able to do it like this. Then EBIT level of EBIT level of 5 lakh, 5 lakh. Second EBIT level is 10 lakhs. And then we have 15 lakhs. So EPS numbers are EBIT minus interest is 3,30,000 to 0.75. Make it as 1 minus T. 0.75 minus 1,20,000 reference dividend. This entire thing divided by 1 lakh. So these are the EPS levels for 2.075, 3.825. These are the EPS levels. Explain the relationship between break-even point and financial risk. And what can you say about the relation between break-even point and the financial risk? What's the relation between break-even point and financial risk? Or is there really any relation between financial risk and the financial break-even point? Yes, if the financial break-even point is higher, the financial risk is also going to be higher. If the financial break-even point is higher, the financial risk is also going to be higher because you need to earn that much additional amount of uh, EBIT to generate profits. So higher break-even point means higher risk. Compare the financial break-even point with break-even operating break-even concept. Financial break-even and operating break-even are obviously two different things because financial break-even is considering interest only as the fixed cost, interest and preference dividend, whereas in operating thing we take the operating fixed cost. Okay, so that's the only difference between them. Now, question 4. Question number 4. Try it out. It's a bit challenging. I mean, a bit different thing. So let's do one thing. Let's take a break now. Okay? And or maybe you can just do it right now and then take a break, and then we will restart at what will take around 10 minutes for you to complete this question and 10 minutes for the break. So approximately 5 more minutes. By 7:30, you should be able to done. So join back at 7:30 to discuss this one and after the break, obviously. So first you solve this and then take a break, guys. After that, we'll look into the capital structure theory part, guys. Okay, complete this. Okay, Asta is asking, sir, when we have three financial plans to find indifference, then there is no indifference between then only we see which financial plan dominates another based on the financial break-even and EPS. If we have three plans, and yeah, true, Asta, you can say that. Because if there's no indifference point between two of them, you can definitely take what you are actually saying. Yeah, not for A you will consider, for between B and C, then you will look at only the financial break-even point. Correct. Okay, complete this and then take a break. We join back at 7:30, guys. Okay. Okay, are we done? What's the operating break-even point, guys? Operating break-even point. Operating break-even point. Break-even point is computed as what? Fixed cost upon PV ratio, which is 8 lakh upon 40%. So 8 lakh divided by 40%. How much is it? Yep. 8 lakh divided by 40% is what? 20 lakhs? Correct. Financial break-even point is financial break-even point. Financial break-even point is interest plus preference dividend. There's no preference dividend, so only interest. So 2 lakh. 20 lakh is the operating break-even point, and financial break-even point is 2 lakh. Right, guys? Got it? Then determine the combined break-even sales. Combined break-even, when we say, we do the same thing. Um, in plan one, yeah, financial break-even point in plan one, it is 0. And 2 lakh is for the second plan. We have to compute the combined break-even point. So in that situation, the fixed cost is going to be 8 lakh plus also the interest of 2 lakh. And then that divided by the PV ratio of 40%. So 8 lakh plus 2 lakh, which is 10 lakh divided by 40%. 10 lakh divided by 40%, which is 25 lakhs. That's the combined break-even. Analyze how operating and financial leverage interact. So operating and financial leverage, is there any interaction between them? Yeah, if the operating leverage is high, financial leverage is going to be lower. Because if your operating leverage, because we know operating leverage is computed as what? Contribution upon EBIT. Financial leverage is EBIT upon PBT. If your operating leverage is high, this means your EBIT is lower. And as your EBIT is lower, as the EBIT is lower, financial leverage is also going to be lower. It can be that just done on a intuitive basis. If your operating leverage is high, EBIT is going to be lower because that's only connecting with the next part. And if your EBIT levels are lower, of course, the financial leverage is number is also going to be a bit lower. Okay. Recommend plan based on risk amplification. Um, Now, if it is to be considered from a risky point of view, since you're already operating leverage is, I mean, operating break-even point is 20 lakh and financial and operating combined is 25 lakh. This is 20 lakh and this is 25 lakh. So you're adding that additional 5 lakh because of financial leverage, right? So we can definitely say that additional 5 lakh is getting added to the break-even part. But if the company can afford it, then it should go for the debt financing. If the company can't, then it should go for the first plan. Okay. Then right now, let's just quickly go through uh, what we call as the capital structure theory. So let's quickly run through the capital structure theory part. Right? So we know capital structure theory is all about a debate. It's basically a debate between two set of school of thoughts. One is said to be a theory of relevance, and another is a theory of irrelevance. So theory of relevance is the one where we say it is a net income approach, whereas theory of irrelevance is net operating income approach. So theory of relevance says that capital structure is going to have an impact on the value of the company, and irrelevance says that capital structure is having no impact on the value of companies. Okay, so there we have three theories, and other we have two theories. So net income approach is what we say as the cost of equity. As the weightage of debt increases, KO decreases, and due to which the value of the firm is going to increase. But here, one thing that was forgotten was you're assuming KE and KD as constant, whereas when we go to the next theory, which is net operating income, we say that as the weight of debt increases, KO is decreasing, but there is another aspect to it, which is since the KO is constant, value of the firm. There's another aspect where as the value of debt increases, equity shareholders start asking for a higher rate of return, and due to that, the KO instead of reducing, it becomes constant, and therefore the value is going to be remaining same. Then the third phase is where the bankers are also starting to ask for a higher rate of return. So there you have a optimal phase in between, and then so very low leverage and very high leverage both are not preferred in this. One important relation between levered and unlevered firm is if it is in the absence of any taxation, value of levered firm and unlevered firm are going to be same. But if there is a taxation applicability, then we say that the value of levered firm is going to be equal to value of unlevered firm plus the value of debt into tax rate. So that's the value of the levered firm. Okay. Okay. Fine. So let us do some questions based on it now. Let us try to go for this. Yeah. Question number 6. Value of both firms under NOI approach. That is one thing you need to compute. Determine the cost of equity for leverage firm. Cost of equity for leverage firm. Show that KO remains constant. That's a separate thing. So essentially what you have to compute is value of both firms and also KO. And if the values are diverging, then arbitrage, how is it going to happen? And evaluate the real world implication. So first you get this value of both firms, cost of equity and KO. Try to calculate these things, guys, quickly. Try to get these numbers. The firm increases the equity capital more than 10%, expected PE will increase to 8.5. So here the equity capital includes reserves also. Equity capital, yeah, it will include obviously the reserves also, true. Now, let's try to solve this. Hmm. Equity cap, but you're saying one second. It's only capital amount. But the wordings are equity capital only, right, Asta? Is the word equity or equity capital? What are the wordings? Equity capital. Then only capital will be included. Yes. Okay. So we have two companies over here, unlevered and levered. Now we have the EBIT values. EBIT is 20 lakhs for both. And then you subtract interest from that. Interest is 50 lakh into 8%. 50 lakh is the debt amount, 8% is the rate of interest. So 50 lakh into 8% is what? 4 lakh. Yeah, 4 lakh is the interest amount which we have in case of the levered firm. Unlevered firm doesn't have any. We have the PBT as 20 lakh and 16 lakh. No tax is applicable, but we know the KE. KE is going to be for unlevered, it is 12%. And here's something, which we don't know. But I can get the value of equity for the unlevered firm, which is 20 lakh divided by 12%. Value of equity is 20 lakh divided by 12%. So this works out to be 1 crore 66 lakh 66,000. 1 crore 66 lakh 66,667. 1 crore 66 lakh 66,667. Since the value of debt is zero, value of firm will be 1 crore 66 lakh 66,667. And since we are using the word net operating income approach, so net operating income approach, it is going to be same 1 crore 66 lakh 66,667. Of course, from that we will subtract the value of debt. Value of debt is 50 lakhs. We get the value of equity as 1 crore 16 lakh 66,667 as the value of equity. Value of firm minus value of debt, that gives us the value of equity. So after this, we got the value of equity. Value of firm is 1 crore 66 lakh 66,667. From that we subtracted. We got the value of equity. So we got the value of both firms. Now the cost of equity. So cost of equity will be PBT, which is 16 lakh divided by 1.166667 crores. So this is what 16 divided by 1. 9.63%. Or 1 second. 9.63. PVT is 16 lakh. Interest cost is at 8%. So 20 lakh, or it is 16 lakhs divided by 1 crore. 16 lakh. Okay. 1 crore 16 lakhs. 66,667. Yeah, this is 13.71%. KO is definitely going to remain same, because even if you calculate the, I mean, since the value of the two firms are same, the overall cost of capital is also going to same. And if there is a diversion in the values, then you will say obviously arbitrage comes in. If Modi Gill and Miller approach, then we'll add 4 lakh the value of unlevered. That will be applicable only if it is no tax is there. Whereas without a tax, your Modi Gill and Miller model and net operating income model are just one and the same. Okay, got it, guys. Now, let's go for one more question. Mhm. Okay, try out this question. Question number 9. Try out this question, guys. Question number 9. Try this. Okay, so EBIT is 12 lakh, debt is 30 lakhs. At 10%, K unlevered is 15%, tax rate is 30%. So compute the firm value using net income approach, net operating income approach, and with taxes approach. Okay. Compare the WACC under each of the approach and how leverage impacts. Fine. So let us first talk of the net income approach. Under net income approach, we have the EBIT number. EBIT is 12 lakh. Of course, from that, we are going to subtract the interest, which is 3 lakhs. And we are left with PBT of 9 lakhs. From that, we're going to subtract tax at the rate of 30%, which is 2 lakh 70. 9 lakh into 30%, 2 lakh 70. Then we have the profit after tax as 7 lakh, not 7 lakh, but 6 lakh 30,000. KE unlevered is 15%. So for unlevered, it is 15%. Now in net income approach, we say that K is obviously not going to change. Whatever is for the unlevered, same is good for the levered also. So we simply say K is going to be 15%. That will give me the value of equity. Value of equity will be 6 lakh 30,000 divided by 15%. 6 lakh 30,000 divided by 15%, which is 42 lakhs. And then value of debt is anyways 30 lakhs. So the value of firm is 72 lakhs. Okay. Then we have net operating income approach, NOI approach. PBT tax and everything is same. But in NOI approach, we say that KO is something we can't calculate. Okay, so in NOI approach, this exactly is just the replica of this, but I can't go ahead with KO. Rather, I need to look at first KO. So since it is like unlevered 15% KE, that's it, which is going to be the KO. So this is also going to be 15%. Now we get the value of firm directly. Value of firm is EBIT upon KO. This EBIT on KO. So where the EBIT is 12 lakh upon KO is 15%. Okay. EBIT is 12 lakh upon 15%. Rather, it's going to be, since it is after tax, we'll say 12 lakh minus 0.3 upon 15%. Is 12 lakh into 0.7 divided by 15%. So value of the firm is now 56 lakh. And from that, we subtract the value of debt. Value of debt is what? 30 lakhs. And we get the value of equity as 26 lakhs. Okay, that's the NOI approach. Then with taxes, I need to get the value of unlevered firm. Value of the unlevered firm. Now, value of unlevered firm will be, of course, PAT divided by K itself, which is so that PAT is going to be what? 12 lakh into 1 minus 0.3 upon K is what? 15%. So 12 lakh into 0.7 divided by 15%, which is 56 lakh. Is the value of unlevered. So value of levered will be value of unlevered plus amount of debt into tax rate. So value of unlevered is 56 lakhs plus amount of debt, which is 30 lakhs, into tax rate is 30%. 56 lakh plus 30 lakh into zero point 0.3, which is 9 lakh, plus 56 lakhs, 65 lakhs. Value of levered form is, guys, 65 lakh. And of course, the value of equity over here is going to be 65 lakh minus 30 lakhs. So under Modigliani-Miller approach, this is 35 lakhs. So we have done all the three approaches: net income approach, net operating income approach, and also the with taxes. Now we'll compare the WACC under each approach. Under net income approach, KO is EBIT. In fact, I can calculate the KO under this is K is 15% into 42 out of 72 plus cost of debt is what? 7%, because we need to make it after tax. So 7% into 30 out of 72. So what is the value of KO? In all approaches, we consider taxes. Yes, we are considering taxes in all approaches. The tax rate is given. So what is the KO in net income approach, guys? 15% into 42 by 72 plus 7% into 30 by 70. What is this number? What will be the value of without taxes? Then you won't end up. In fact, in without taxes, value of levered and unlevered will be one and the same. So how much is this? 42 divided by 72.5833 into 15, 8.75, 8.75, 8.75 plus 2.9. 8.75, that's 11.67%. But in unlevered, we consider taxes. Eh? What are you saying, unlevered? Be it levered, unlevered, if taxes are given, we consider taxes. If tax is not given, we not consider tax. Then under NOI approach, it is going to be 15% into 26 out of 56 plus 7% into 30 out of 56. Okay. So what's the cost of capital in NOI? 26 by 56. Into 26 by 56 plus 7 into 30 by 56. Okay, this is 10.71%. Okay, and then in case of Modigliani-Miller, this is going to be KO equal to 35 out of 65 into 15 plus 30 out of 65 into 7. So 15 into 35 out of 65 plus 7 into 30 divided by 60. That's 11.31%. All three are having different values of KO. One, it is 11.67. Second value, it is 10.71. And approach, it is 11.31. Okay. In traditional approach, KO is affected by KO is affected by both KO and KD and KE. In fact, it is affected by the amount of leverage, the amount of debt that you have. Okay. It is affected by every amount of debt. In fact, KE and KD, both of them change with the amount of debt. So it's impacted by the value of debt, you can say. Okay, fine. So with that, we are through with our today's session, guys. We have revised the concepts of capital structure, both for capital structure problems as well as capital structure theory. Right? We have done quite good number of questions. I've already uploaded this file on the viewers portal. You should be able to access it. Okay. And so with that, let's just stop here for the day, guys. All the best for your exams. And are there any queries? Weight of equity KO is affected by weight of debt, weight of equity is affected by weight of equity. Weight of equity KO is affected by. I'm not getting your question, Asta. Weight of equity KO is affected by in traditional something, we have not written it, structured it properly. Your value of KO is affected by KE and KD as well as weight of debt and weight of equity. As the weight of debt increases, the amount of debt, the cost of debt also increases. KO is affected by weight of debt, weight of equity. Yes, of course, KO is definitely affected by weight of debt and weight of equity. In fact, it's also affected by the changes in cost of debt and cost of equity. Okay, fine. So with that, let's just stop here for the day, guys. See you. I don't know when, but hope to see you again. So in the probably the next class of CA final. Okay. So all the best, guys, for your exams. Thank you. Good night and take care.